Between 1999 and 2000, the Dow Jones Transportation Average began to move lower, marking the beginning of a major divergence between transportation stocks and the S&P 500 index that was consistently making new all-time highs during that period. The decline in the transportation sector anticipated one of the most important market peaks in history. If we rewind to 1972, we see a similar pattern. The Dow Jones Transportation Average began to decline in April of 1972, while the rest of the US stock market continued to move higher. The S&P 500 index made a new all-time high in January of 1973, but eventually the S&P 500 caught back down to the transportation sector. Fast forward to 2025, and we see something quite similar. The Dow Jones Transportation Average has completely diverged away from the US stock market that has been consistently making new all-time highs over the course of the last year. Today, the transportation sector is 6% below its all-time high from 2021. Meanwhile, the S&P 500 index is 26% above its all-time high from 2021. The use of the transportation sector as a way of predicting a peak in the stock market is called Dow theory, a strategy that was developed in the 1900s. And this is something that we could see talked about more and more as this gap continues to build like it did in the 1990s and the 1970s. The question today is whether Dow theory is suggesting that the stock market is in the process of putting in a major peak once again, like the one from 2000 in 1973. By the way, we are doing a large discount on our service for this new year. We want to make sure that we're giving everybody a chance to kick off 2025 having access to our trading strategy. We provide buy and sell alerts to our members each week that have provided fantastic returns throughout 2024. The month of December has been a little bit tougher for us, ending quite a long streak of big gains on our service. We try to be as transparent as possible when we go through these kinds of period of weakness, because at the end of the day, this is part of trading. Our mission is to make sure that each and every person that joins our service comes out consistently profitable. Don't miss your chance to join our community. The transportation sector is what's called a cyclical part of the economy. That means that transportation stocks more accurately reflect where we are in the business cycle. Indeed, transportation companies thrive when the economy is booming and a large number of goods are being produced and bought, because these goods need to be transported. If the economy is slowing down and less goods are being bought, well, it's less likely that we'll need a significant amount of transportation in that environment. And so the earnings of these companies are going to go down. What often happens before economic downturns is that transportation stocks actually go down first, while other parts of the market that are less sensitive to the business cycle continue to hold the market up. But once the downwards pressure from the economy becomes too great as you enter a downturn, the rest of the market eventually catches down to the transportation sector. This is what we saw in 1999 and 1972, but we also saw something quite similar in 2015. Here, the Dow Jones Transportation Average was steadily moving lower, while the stock market kept on moving higher. A few months later, the S&P 500 peaked and caught down to the transportation sector for a 15% decline. Rewind to 1989, in the year leading up to the 1990 recession, the transportation sector began to move lower, while the rest of the US stock market was making new all-time highs. Eventually, the S&P 500 caught down to the transportation sector, declining rapidly by around 20%. But there is a crucial difference between all of these episodes that we just looked at and today. Today, even though it is underperforming, the transportation sector is still generally trending higher. It's making higher lows and higher highs, which is the definition of an uptrend. We can also see this by looking at its moving averages. For now, the moving averages on the Dow Jones Transportation Average are still pointing upwards. If we rewind to 2015, we definitely can't say the same thing. The Dow Jones Transportation Average was moving lower and the moving averages were curling downwards. In 1999, again, the transportation average was moving lower and its moving averages were also pointing down. And again, if we rewind to 1972. So the gap that we have today between transportation stocks and the S&P 500 could very well continue to get larger and larger over the coming months. And we can get an idea of how big this gap could get by looking at the performance of transportation stocks against the S&P 500. And we can call this the transportation to S&P 500 ratio. And this is what that ratio looks like going back to 2008. Since October of 2023 right here, the transportation sector has underperformed the S&P 500 by a massive 27%. But if we zoom out just a little bit more, we see that things actually got a lot worse than this in 1999. From January of 1998 to January of 2000, the transportation sector underperformed the S&P 500 by a massive 50%. It wouldn't be so crazy to compare 2025 to 1999. We've shown many other similarities between these two episodes in prior videos. Today's stock market environment is remarkably similar to the one from the late 1990s, and I can prove that simply by showing this chart right here that tells us what percentage of S&P 500 earnings are being driven by growth stocks. Today, 50% of S&P 500 earnings come from growth stocks. In 1999, that number was also particularly elevated. This is incredibly different, for example, to the period between 2001 and 2008, where growth stocks only represented about 10% of S&P 500 earnings. Back here, what's called cyclical stocks, like the transportation sector, represented almost 80% of S&P 500 earnings. Today, that number stands at 30%. This is very important because it means that transportation stocks could continue underperforming the market without necessarily having a negative impact on the S&P 500's performance. In fact, we can argue this could get a lot more extreme than it did in 1999. So while this divergence is suggesting that there is trouble brewing underneath the surface, and that has usually not ended well in the past, the truth is that this gap could get much larger than it is today before the S&P 500 catches down to these more cyclical parts of the market like the transportation sector. This is why we have a net long exposure to the stock market today with the active trades that we have on our website. We've been using the recent market volatility as an opportunity to add new trades, and we've actually increased our exposure to technology stocks and are exposed to companies like Amazon, Google, and Klaviyo that we expect to be major outperformers over the next few months. If you want to follow all of our trades step by step, make sure to join our website. Make sure to take advantage of the New Year discount that we're doing to get access to our service at a reasonable price.